great. Well, thanks. Thanks, guys. Good to meet you. And I got two screens, so when I'm looking over here, it's because I'm looking at you, and I got my presentation over here. So, and just to correct, I'm not a CPA. Just I have to say that I'm a chartered accountant. I did all my studies in England, so I got qualified over there. So, just for clarity, I don't do taxes or audits. I do everything that's not compliance. Lots of accounting, lots of CFO type stuff. So hopefully, so I'll go through the presentation. I just share my screen here. And shoot this one. You guys seeing that okay?
Yep, looks good on our end.
Great. So I know we've probably got, I think about 45 minutes or so. So my plan is to kind of go through this fairly quickly, probably within 15 to 20 minutes, and then try to open up for Q&A. So some of this, hopefully I'm not teaching you guys to suck eggs. Some of it's probably gonna be fairly basic. Some of it may not be, but I'm just gonna kind of go through it, and then we'll do a bunch of Q&A at the end so that I can try to address any specific questions you guys might have. It's a pretty broad topic, so try to put some content in here, but we could go hours and hours, and I could bore you to tears. So hopefully this gets you what you need. So kind of cracking through. If my computer works here. There we go. So in terms of kind of just content, I got about 6 or 7 slides. So we'll kind of go through some common accounting terms. And this is sort of some bullets I was sent in terms of what I think you guys were looking for. So we'll talk a little bit about accounting systems and how you'd scale those up. We'll look at some general financial reports, P&L balance sheet, that kind of stuff. We'll touch on internal controls. That is a whole week of CPE if you're ever really bored. But we'll kind of touch on the key points for you guys would probably be applicable to. And then we'll get into some startup measurements and other KPIs that I think probably be more applicable to, as you guys are growing your businesses and kind of growing them out, what might be relevant. So feel free to stop me anytime, but if you ideally, probably I'd say I can ramble through this in about 15 minutes, make notes, and we'll do Q&A at the end. That way we can kind of try to focus our questions in the right areas. Prakash, with these sent, I think, does everyone have a copy of these anyway?
They don't, but I can send one out.
Okay, you can send them afterwards, that's fine. So just wanted to kind of really touch on some real common financial terms. This is probably where I'm maybe teaching you guys to suck eggs a little bit, but some real basic stuff. But I've also found that people don't always know what these are. So then they're sort of afraid to raise a hand because it's sort of so simple. But just kind of running through the list, some things you guys should be aware of as you progress on the financial side. Gross profit, fairly straightforward. That's your revenue less your costs, right? I think most people are familiar with that, but it's your direct cost of goods. So if you're making a product, it's your materials that are going into it. It's not your overhead, which is your rent, your payroll, those kinds of things. So gross profit is the money you're making on each individual item you're selling. The two that I find get completely kind of mixed up sometimes is gross margin and markup. So gross margin is how much money are you making on your revenue, and markup is how much money are you making on your actual cost, right? So if you're selling something for $100 and it costs $50, your margin is $50, which is 50% of what you're selling it for, right? If it's the other way around and your markup is 100% because you're making $50 on something that costs you $50. So I see those kind of get turned around a lot, and it has a massive impact on your P&L projections and things like that. So again, just put it in here for just make sure we kind of check it off. EBITDA, earnings before interest, tax, depreciation, amortization. This is something you guys will become familiar with as you grow and have profitability. And everyone, a lot of valuation models will be based off what we call EBITDA. And the reason we look at EBITDA, which is really your net income, which is here your bottom line, right? Your net after everything. It's adding back things like taxes, depreciation, amortization, and interest, because those things are not used, A, for cash, and B, for operations. So interest is completely dependent upon the debt structure you have. It's not dependent on how you operate. Depreciation, amortization are not cash outflows. They are just write-offs of assets you've acquired over time. So EBITDA, the reason people use EBITDA for valuation, it's a very quick and dirty way to kind of try to figure out what the cash flow of the business is. So that's a term you'll see all the time when you talk about valuations and things like that. Cash versus accrual, we'll touch on a little bit with financial reporting. Less to worry about, early stage, but the one thing to note here is when you come to do valuations and you come to look at businesses as they grow, most people are going to look at it on an accrual basis. And the simple way to talk about accrual is I call a matching concept, where you're trying to match revenues and expenses, right? So real kind of high level example, someone gives you $1 million in December to produce a bunch of stuff that's going to take you all year to do. You want to make sure that the revenue, the $1 million you just got, applies to when you actually deliver those products. Okay, so you don't want to make $1 million of revenue with no expense in 1 year and $1 million of expenses with no revenue in the next year. So that's why we call it the accrual method. That is the accrual method. Cash would just be, hey, I just got a bunch of cash, and then cash goes out the door. And the reason that's important is accrual gives you a better sense of what the business is doing, and is it really growing? Is it really profitable? Is it growing in the right direction? So we'll touch on that with the financials. Working capital, again, a phrase that'll come up quite a bit, I would think. That's just your current assets and your current liabilities. So it's just your, what do you owe versus, what do you have? So accounts receivable, accounts payable, right? Cash, inventory, those things would be working capital. The reason that's important is as you build a business, if you're going to sell stuff and you're going to sell it on credits, you're going to have receivables. If you're going to have inventory, you need money to invest in working capital, because that's money that's essentially sitting on your balance sheet that you need to fund, right? And so if your business is going to have a lot of inventory, you got to know that, because that's going to play into your investment strategy. For startups, run rate is something to figure out. And that's key for talking to investors. Run rate typically is how much cash burn do you have, but you can kind of break it into revenue run rate, expense run rate, and basically your net run rate. So revenue run rate would be your monthly incremental revenue, especially in a SaaS business, right? If you've got 100,000 coming in every month and you're adding new customers every month, you can see what your run rate would be going down the road, and your historical financials won't necessarily replicate what you're currently doing from a revenue standpoint. Same with expense run rate. As you add people, you kind of look at what your current monthly expense is and extrapolate it out. So this one's fairly key for people that are looking at startups, and they're going to ask you, what is your run rate, so that they can kind of project out at what point do you become break even. Another one that you may hear, capital stack. So this is how you're funding your business. So, two common ways to fund it is through debt or through equity. And then within those big buckets, there's a bunch of different ways to do it, with lines of credit, credit cards, loans. Equity would be, common equity, cash, friends and family money, preferred equity. Vendor financing is another way. I mean, that's sort of AR or sort of AP aging, to your vendors give you sort of special terms and things like that. So that's something that might come up down the road as to how you fund it. How much debt versus equity do you have? And is it the right balance based on where you're headed? So again, some common terms there. Accounting systems. So I want to touch on this. We can kind of run through this fairly quickly. The one thing I've seen is people kind of jump way into complex accounting systems way too early. Accounting systems, especially complex ones, are very expensive. I would say you've got kind of 4 main levels of accounting systems to track everything, right? To report on. Excel being the primary one. Nothing wrong with Excel. For a startup, just, take your bank statement, plug in, the numbers from your bank statement and put them in Excel, and, you're pretty good to go. Now, the negative of Excel is obviously you could accidentally delete a file and you're, have to do it all again. So it's not great from that perspective. There's no real accounting going on. It might not balance, but nothing beyond that is needed, I think, early on. As you start up and you start having financial activity, honestly, QuickBooks Online is probably the way to go. Xero is another solution. The beauty of those is they tie right into your bank account. So all your bank entries kind of funnel right in your accounting system, and then you just code. So you don't have to be an accounting person to kind of at least do the real basics and track, revenue and expenses. So that, and honestly, QuickBooks will take all the way through to being a large, small business. There's no real reason to go beyond that. And I would say, when you look at the upper levels of accounting software, the fully integrated solutions, the mid-tiers and the full ERP solutions, if you've heard of NetSuite, SAP, those kinds of things, extremely expensive to operate, extremely expensive to set up and everything else. You don't even want to go down that path until you've got an actual accounting department. So for startups where you're probably doing a lot of the accounting yourself, QuickBooks Online is probably the first step you'd go to. The other beauty of that is you can tie it in with any operation software you would need. So if you have a CRM, or if you have some kind of inventory or time management software that you need for your business, go find something online that's, a monthly cost, 10, 20 bucks a month. This is about 10, 20 bucks a month. And they generally will talk to each other. I would stay away from QuickBooks Desktop. It's a sort of dying product. It's cheap, you buy it once and you can use it, but it's hard to connect it to things. So if you do have a CRM or some kind of operations software or some point of sale, and you want that to connect, online is almost certainly going to connect. Desktop's probably not, or you're going to have some intermediate thing that keeps breaking. So, so that's where I kind of say from an accounting system standpoint is where you want to be. Financial reports. So there's really 4 primary reports that you're going to want to have. And I'll kind of touch on each of them. P&L is what most people have heard, right? Income, less expenses, how much are you making? Obviously pre-revenue, that top line is 0, but you're going to see tracking your expenses. So I got a couple of examples. I don't know, if you guys have seen financial reports or what they kind of look like. So I'll just pull them up quickly here. P&L, very straightforward. Revenue, this is your cost of goods. So this is your inventory. This is your products, your actual materials or direct labor to produce whatever it is you're producing. If you're a software company, this would be pretty minimal, maybe some hosting fees, things like that. And then you have all your overheads down here, advertising, payroll, rent, blah, blah, blah. This right here is a pretty good example of all the various categories, and that's just plugging stuff in the right place. To get down to a net income number, most people are familiar with income statements, fairly straightforward. Balance sheets, not so much. Balance sheets are a bit more complicated, a bit more accounting related, but it's as simple as what do you have and what do you owe, right? The way I kind of look at the two financials is just think P&L is your performance and balance sheet is your financial strength, right? So real simple, kind of at the very top is all your assets. It's your cash, it's your inventory, it's the things you have. And then this section down here will be everything you owe, debt-wise, accounts payable, things like that. You'll see some like deferred revenue and other things that we don't need to touch on today. And then at the very bottom is your equity. So how much money is actually been put into the business to actually sustain it, right? So if you didn't put anything in and you just ran everything through debt, then it'll be up here. But if you put in actual cash, it'll be down here. So balance sheet has to balance. If you're ever wondering, like Enron and those guys, when they faltered, if you're ever doing like stock market stuff, always look at the balance sheet, don't look at the income statement. Because that's going to give you a sign of, the winners and losers. Those with the strong balance sheet will always be the winners. So obviously in a startup, your balance sheet's probably going to be not pretty, but as you create those profits and you get the right capital structure in place, then that's where you want to focus. The other one that most people don't do is a cash flow statement. I don't know if you can see this. Let's see if I can blow it up a little bit. This is the way we do it in an accounting world. There's really 3 components to cash. And again, this is another indicator of financial strength. The very top section here, this is the cash generated by operating activities. So this is how much cash do you generate from selling your product and spending, paying the bills to make the product. So ideally, this needs to be a positive number, right? At some point. Obviously, in a startup, it's generally going to probably not be a positive number. The next section down is then your investing activity. So how much cash are you generating or spending on things like fixed assets or investments? So this is usually a cash out kind of thing where, you're buying equipment. So you're making money and you're using it to buy equipment, right? That makes sense. At the very bottom, you've got the financing activities such as debt and equity. So when you look at these 3 components, money's going out the door to fund debt, but money's coming in from operations. So that's a healthy company, right? If this was all negative and then you're just getting money in to offset that through debt and equity, that's what I would expect in a startup. So you guys would probably be in that boat for a short period of time. But at some point, you got to flip those things because you can only fund negative operations for so long, right? So cash flow statements, not something you guys need to worry about at this point, but it's kind of key. Cash flow on the balance sheet really gives you a better picture of what's going on with the business. Is it really making money? Is it really generating cash? Is it in a strong financial position? More so than the P&L. So those are the kind of the three typical financial reports. Again, in terms of where you guys are at, startups, focus on the P&L, then the balance sheet, and then the cash flow. In terms of kind of how you report those, I would say, P&L is one where as you grow, you want to be constantly comparing it to your budget and your prior periods. So whether it be, I always like to see a 12-month P&L because it really gives you a sense of what's going on with the business. Your expenses are growing, especially in startup. You see those expenses going and going and going. But then you start seeing that revenue cutting in, and then hopefully you see that growing and growing. And so you're trying to do this, projection of, well, if the revenue keeps doing this and the expenses do this, eventually revenue surpasses expenses, right? And you're trying to predict out at what point does that occur. And so having that period of time so you can see you're making progress is key. Balance sheet, less important, it's more critical as to what is it today. Cash flow, again, you could do it by month, same as P&L. Just look at what's going on with cash over a period of time. The fourth one, which I would say this one's actually most important for you guys right now, is the budget and the / cash flow projection. So every time I look at a business, especially if it's for sale or if it's in startup mode, I want to see what is that 5-year plan. And specifically, I'd like to see the next 2 years on a monthly basis. So what does that financial plan look like? And it just needs to be in a P&L format, right? When does revenue kick in? How does revenue grow? And then what the expenses look like to support that revenue over a 24-month period on a monthly basis. And then, extrapolate that out for years 3, 4, and 5. So that's a keys and I can't remember, I think you guys are probably having some different education on sort of pitching and raising money and those kinds of things, but that will be critical for that kind of effort. So internal controls, procedures. I would say, unless you guys really want to be accountants, it's not something you really need to worry about. For now, early stage, the big issue with internal controls is what we call segregation of duties, right? Having one person doing everything is high risk, right? They could take away cash and you wouldn't know about it. So segregation of duties is key. The problem is when you're a small business, you don't have 5 people in your accounting department, so you can't have someone do one thing while the other person does something else. You're going to be reliant on someone doing all of it. So this section here is what I would say you guys should focus on. Generally, you want to reconcile your cash every month. So even if you got a bookkeeper or someone, have them reconcile your bank statement, making sure that your financials and your bank statement are the same, right? That they're tying out. You should be paying all your bills so that you know what's going out the door and you're reviewing it before it goes out the door. You should review your bank statements every month for the activity. So every time you get that statement, of course now it's all online, but I would go in there and check your activity, have alerts, whatever, so you can make sure what's going through there is what's expected. The other thing, as you start generating revenue, if you're doing invoicing, always review your accounts receivable aging report. That's something you'd get out of QuickBooks if you had it in there. If it's in Excel, hopefully you've got the date the invoices were sent, but that's something you should be doing every week because you want to make sure if something's getting behind, you know about it and you don't find out 3 months later. Accounts payable, same thing. Having a list of your payables and making sure that the ones that are oldest are getting paid on time so that you don't end up in a situation where utility bill gets cut off or something like that. And then inventory, if you have any inventory, just making sure you're getting a good solid report on what inventory you have and obviously making sure it's not going up if it's not supposed to be going up. So those are the things as an owner, as you build your business, I'd say if you focus on those things all the time, even when you've got a full accounting department, if they're just giving you these reports, that's kind of key, number one. You know, as you scale, really you just hire an accounting department and they should kind of have those segregation. But really, you know, what I talk about the separation of functions. So if you had people where they're doing the day-to-day entry of data, someone else is doing the approval step, right? So if you had a bookkeeper, you got to a point where you've got a lot of activity and you've got someone entering your data into an accounting system, then be the one that signs the checks, right? Be the one that reviews those reports. That way you've got two sets of eyes looking at the same data. And then, yeah, just hire control at that point. So startup measurements. So what do I think, like, for a startup you should be tracking? First and foremost, gross profit, if we touched on. You want to make sure your product is profitable, right? I mean, it sounds stupid, but it's kind of key. And you know, you're not going to make it up in volume if it's not profitable. So you've got to make sure that the margin is profitable, and also understand what it is at scale. So if you've got a product and it may not be profitable initially, you got to see how does it become profitable, right? If I make one of these items, it's so expensive, but if I can go to manufacturer and I can make 1,000, suddenly I'm making 50% margins. So you got to know what your margin or your gross profit is on your product. Again, software should be profitable, right? There shouldn't be a whole lot of ongoing cost. And I don't know if I touch on it here. The delta here is, especially with software, there is a cost to usually developing it and maintaining it. So you do need to factor that in, even though it wouldn't be considered a direct cost, it's your overhead. So I have seen situations where, you know, maybe the software is relatively cheap, but the cost to deploy it is actually very expensive because it's got to be customizable. So if you're going cheap software, it's got to be off the shelf, right? It's got to be someone just signs up online, downloads it, and takes care of their own business. If you're having to set them up and do a lot of the onboarding, then the software better be expensive in order to facilitate that growth, right? So other things you should know is revenue per customer or per transaction. Depends on what you're selling, but you know, SaaS type business where you're looking at how many transactions in a given year and customers repeat. You know, everyone loves to invest in recurring revenue. Right? It's a sort of like, you know, every investor will tell you, oh, recurring revenue is great. Well, sure it is, but there's a lot of businesses that you may have one, you know, you sell it one time and you're done. So understanding what that is, because that will play into the next one, which is cost to acquire customers. So if a revenue per customer is X dollars and it's one time, then you need to really understand what your cost to acquire a customer is. And how you do that would be things like your marketing costs, your sales commissions, anything that's marketing, sales driven to bring customers in. You would take what those costs are over a period of time, ideally say a 12-month period, and look at how many customers you've acquired, new customers, and divide those numbers so that you can identify what does it really cost you to go get a customer. And then, you know, if it costs you $1,000 to get a customer and they're a one-time customer, one transaction, and it's $500, you gotta relook at your business model, right? If, however, it's $1,000, but a customer, once they're signed up, they're a 3 to 5 year term, they pay every month, and they're spending a couple $1,000 a year, then it suddenly makes worth it, right? But these, as investors kind of start looking at your businesses, this is kind of a key element they should be looking at, because they're trying to figure out at a scale, if I keep putting money into sales and marketing and I keep bringing in new customers, I want to be making more money, right? And I don't want to be spending a ton of money just to get one sale, because I'm never gonna make, you know, my returns on my investment. So those would be, and it doesn't have to be perfect. I would say start somewhere, just track that data, and you'll probably enhance it and tweak it over time. Customer retention / attrition, this is key, especially if it's like a SaaS business. You know, how many customers are you attracting on a, you know, and is that growing? So more and more as the people become aware of your product. But then what's your retention rate? So again, if it's a one-time product, then your retention rate is, you know, it's the customer comes in, they go away, right? But if it's a recurring type product, then how often do they come back, or do they then go elsewhere? So knowing your retention rate is key, and your attrition rate, because those also factor into your budgets and your projections. So if you're saying, hey, I'm going to grow my business like this because I keep adding these customers, but you're not tracking with what, your attrition rate is, someone's going to look at the two deltas and say, well, your attrition rate's like this, and you say you're going to grow like this, which means you got to be getting like a ton more customers to offset your attrition rate. Run rates we touched on. Again, just know what those are. Break even target. So this is the point, and this is key when you get into investment discussions with people. What they're going to want to know is, at what point is your business cash flow sustainment, right? So at some point you get over the threshold where your revenue exceeds your expenses permanently, meaning you're now making a profit, you're now generating cash that can ultimately come back to investors or get reinvested into the business. This target is kind of, really important in that, because if you said, well, next year I need $500,000 to operate, right? Because I've done my budget for expenses. Well, you may need $5 million to get to break even. So you need to know where break even is, because if someone was going to invest $500,000 for the next 12 months, but then they realize that you really need 5 million, then they know they're going to get, marginalized down the road if they don't have the cash to come in with that later round. So as you start talking about rounds of investment, and there's probably a different education topic, but you really got to understand where that break-even point needs to be at, so that you can go with a pact of, look, we need 5 million to get to break-even or to sustainment, but we only need $500,000 for the next 12 months. So you find the right investment partner, so you're not having to go back to the well every time and find new investment partners, upsetting the old ones that came in and didn't realize they were going to get, marginalized on the second round. So those are key. Another one for investment purposes would be addressable market size, which again, it's kind of a bit of a shot in the dark, right? But anyone who's investing has got to see that there's an actual size, big enough marketplace for this to go into, that your revenues and everything else could get to where they need to get to. So other things to think about from a financial KPI, so key performance indicator, so things you should track. One thing to remember, financial reporting is a historical look back, so it's what I consider a lagging indicator. One of the things we look at when we acquire companies for clients, we try to, if we can, look at order books. Again, every business is different. If you're in construction or contracting where your order book is going to be way ahead of your revenue, you need to be tracking those order books, so that because if you have those when you're bringing in investors and they can see that ramp up is happening in the order book, which will happen earlier than it will in your revenue cycle. And especially if you're on a SaaS, or if you have to spread that revenue piece over a period of time. So again, if you got an order for 20 million for 5 years, right? Well, that 20 million is not going to hit your revenue for 5 years, over a period of 5 years. But your order book says today, I got that contract for 20 million. So you really want to track your order book if that's something that's relevant to your business. Industry specific metrics, there's a whole bunch of metrics out there. I would say try to find stuff that's relevant to what industry you're in, what kind of product you have. Things like costs as percentages of revenue, marketing, payroll, banking fees, those kinds of things. Working capital, are you capitalized in line with industry standards, or do you have like way more inventory, or your AR is way out of whack relative to the industry? All of that, though, caveat to the fact that any industry metrics will be averages. And if you're in startup mode, your numbers are probably going to be kind of way off, but still worth tracking, finding out what those are and tracking to them. And then just, knowing you're probably going to be all over the place initially until you kind of get to, some level of revenue and some consistency. Headcount, FTEs, which is full-time equivalent. So if you have 2 part-time people, you have 1 FTE. That's pretty, I would say track that, especially as you start revenue and costs, revenue by FTE, cost by FTE. That's a good metric, because, if an FTE is 100,000 a year, you obviously want to make sure your revenue is way more than that per FTE, or else you'll never make money. So knowing your FTE and what that scales over time looks like. Balance sheet metrics is another one. AR aging, a lot of it's aging related or cost of capital related. So again, if you've got a lot of inventory or a lot of receivables, it means you're not turning your inventory. So like in the car business, they talk about inventory turns, right? How quickly do they get through their entire a lot of vehicles, right? They want to be turning those cars as quickly as possible. So if your inventory turn is 1, it means you only sold 1 item of inventory once every year. If your turns are 12, it means you're basically replacing your inventory every month. So the quicker you can replace your inventory, the less investment you're having in your inventory balance. Same with AR aging. The quicker you're getting cash in from your customers, the less impact that's going to have on the cash of your business. Your cost of capital, same thing. This capital stack. So depending on whether it's debt or equity, debt is generally going to be cheaper, but it's also got a cash problem, right? You've got to pay for it. You got to pay at least the interest. Maybe you got to pay back the principal. Equity is what we call patient money, but it also has a higher return requirement. So it becomes more costly over time. So you want to find that right balance of having some debt because it's cheaper, but you don't want to have all debt because it's, you could trip over yourself from a cash problem standpoint. And then things like return on equity / assets, probably not relevant for startups because that's taking your income as a relative percentage of the assets you have invested. So that's kind of like your own personal investments, right? Like if you've got $1 million sitting in the balance sheet in inventory and you're making 100 grand a year, you're making 10% on that inventory. So, but until you kind of get to cash, break even and profitability, some of those metrics won't make sense. So that was it. I know I kind of just blasted through a bunch of accounting stuff. Hopefully it was relevant. Hopefully it was helpful. Hopefully you were able to pick some stuff, but I want to get through it because I figured you guys might have some specific questions that I didn't address, or we can go back and talk through some of these in a bit more detail. So.